Turn your pension on and your Social Security on in the same month you retire, and the IRS moves $12,460 of that first Social Security benefit onto the taxable side of your return. Year 1. A $36,000 pension. $31,000 of Social Security. Married, both 65. One benefit. One pension. No withdrawals yet. Not the pension dollar. The Social Security dollar. You did nothing wrong. You did not withdraw too much. The pension did it. Not because pension money is taxed differently. Because it arrived first. It quietly filled the space the tax code gives you before your benefit starts getting taxed, and it filled that space on your first day of retirement. The pension is the floor the IRS formula sees before it sees anything else. Here is what separates this from every other retirement mistake. A pension does not stop. It is a floor of ordinary income that begins the day you sign the election form and runs for the rest of your life. And in many private plans, no cost of living increase is ever attached to it. So this is not one bad tax year. These are the same taxable dollars landing on your return at 65, at 75, at 85. No name here, and nothing to sell you. Just someone who runs the retirement arithmetic the brochure leaves out. In the next 15 minutes, you will see which faucet to open first, which one to hold back, and the single pension form you sign in your last week of work that is usually locked the moment payments begin. That last one moves more money to a surviving spouse than every tax move in this video put together. Almost every piece of retirement advice you have heard was written for a household with no pension. Wait until 70. Convert to a Roth. In the quiet years after you stop working, keep your income under the Medicare surcharge line. All of it assumes a nearly empty tax return in your 60s. A pension means yours was never empty. So here is the number this whole video runs on, using the 2026 federal figures. Married, filing jointly, and both of them already past 65. That household starts with a standard deduction of $32,200. Add $3,300 more for being 65 or older. Add a new $6,000 senior deduction for each of them. $47,500 of shelter. That is the zero tax runway before the first bracket even matters. 2 caveats on that senior piece, and they matter later. It is temporary, written for tax years 2025 through 2028, and it begins shrinking once income passes $150,000. Now stack the 12% bracket on top. This couple can report $148,300 of ordinary income before $1 reaches the 22% bracket. That corridor is the most valuable thing they own in their 60s. It stays open for a limited number of years. Then it closes. The only question that matters is which faucet you open into it first. Quick favor before part 1. Tap like and subscribe now so the next breakdown reaches you before you sign anything. Part 1. Your pension is a floor, not a bonus. Under IRS Publication 575, a pension payment is generally fully taxable ordinary income when you did not pay anything into it yourself. If you did make after-tax contributions while you worked, part of every check comes back tax-free, figured under the simplified method. In many traditional company plans, the worker put in nothing after tax, and then it is 100 cents on the dollar. Your plan statement will tell you which one you are. Now compare that to your other 2 income sources. A Social Security dollar counts only 50 cents toward the test that decides how much of your benefit gets taxed. A 401k dollar counts a full dollar, but you choose when it comes out. The pension counts a full dollar, and you do not choose. Once it starts, it comes every month, whether you needed it or not. Meet the household from the opening. We are going to run it twice. Both spouses turn 65 this year. A company pension of $3,000 a month, $36,000 a year, no cost of living adjustment. $850,000 in the 401k. his benefit at his full retirement age of 67 would be $3,000 a month. Hers is $1,200 a month, $14,400 a year. And she files at her own full retirement age in both versions. That is why the year one math uses only his benefit. Hers has not started yet in either run. They need $90,000 a year to live. Growth held at 5% throughout, so nothing here depends on a lucky market. The only thing changing between the two runs is the order. One more thing about that pension check. $36,000 a year with no cost of living adjustment does not stay $36,000. At 2.5% inflation, in 10 years it buys what $28,000 buys today. In 20 years, closer to $22,000. Social Security gets a raise almost every year, and it never runs out. The pension is the floor that shrinks. Social Security is the floor that holds. $36,000 of pension against a $47,500 deduction. That pension alone is not taxed. That sentence is the whole opportunity. Before Social Security, before any withdrawal, this couple has $11,500 of unused deduction and the entire 12% bracket empty above it. Part 2. The default order and what it actually costs. The default order is not a decision. It is what happens when nobody makes one. The pension starts because the form was in the retirement packet. Social Security starts because the pension is not enough to live on. And the 401k gets left alone because everybody knows you let it grow. So he claims at 65. Filing 2 years before his full retirement age costs him 0.5% per month, 24 months, a permanent reduction of 13.33%. $3,000 becomes $2,600 a month, $31,200 a year, locked for life. Now run the test the IRS actually runs. Take the pension, $36,000, and add half his Social Security, $15,600. $51,600. The joint thresholds are $32,000 and $44,000, and he is over both. That is where the $12,460 figure from the opening comes from. But they still need $90,000 to live, and the pension plus his check only reaches $67,200. So they pull $22,800 from the 401k. Every dollar of that counts in full. The test total climbs to $74,400, and the taxable share of his benefit jumps to $26,520. That is the ceiling. 85% of his benefit, taxable in year one. Federal tax on that year comes to roughly $4,000. Here is the second version. Same couple, same $850,000, same $90,000 of spending. Pension on, because most plans stop growing the benefit at normal retirement age. Check yours. A few pay you to wait, and if yours does, waiting wins. But no Social Security yet. The 401k covers the gap. $54,000. No Social Security means no benefit to tax. $90,000 of income minus $47,500 leaves $42,500 of taxable income, all inside the 10 and 12% brackets. Federal tax, about $4,600, $562 more than the default order. So hold both years side by side. The default order taxes 85% of his benefit in year one, and, on this income stack, every year after. The engineered order pays $562 more now and buys back control over what shows up on that return later. That is the trap in one number. The correct order looks worse in year one. It looks worse in year two. That is why almost nobody does it, and it is why the difference at the end is measured in tens of thousands of dollars. Part 3. The 10-year runway and the wall at the end of it. In that second version, the couple reports $90,000 of income against a corridor that runs to $148,300. $58,000 of unused 12% bracket every single year until Social Security starts. That is the Roth conversion runway. Watch the ceiling carefully because it is not the one people expect. The 12% bracket closes at $148,300, but the $6,000 senior deduction starts phasing out once modified adjusted gross income passes $150,000 on a joint return, $1,700 apart. The Medicare surcharge is the line everybody watches, and here it is, not the wall at all. It is priced off the income figure Medicare reads from a return you filed 2 years back, and under the 2026 table, a couple does not reach it until $218,000. The senior deduction is the wall, and it arrives $68,000 earlier. So they convert $50,000 a year, 5 years running, ages 65 through 69. $250,000 moved out of the tax-deferred account at 12%, about $30,000 of federal tax paid deliberately on their schedule. The tax on a conversion has to come from outside the account for the full benefit, so budget for it. At 70, he files. 3 years of delayed retirement credits at 8% a year take him to 124% of his full benefit, $3,720 a month. $44,640 a year, cost of living adjusted, for as long as either of them is alive. Add her benefit and the pension, and they clear $90,000 without touching the account again. Now the wall. Required minimum distributions begin at 73 for anyone born between 1951 and 1959. Born in 1960 or after, they begin at 75. This couple was born in 1961, so their first forced withdrawal lands at 75 in 2036. 10 years out, the IRS stops asking and starts telling. The size of that order depends on what they did in the decade you just watched. The uniform lifetime table divisor at 75 is 24.6. Two very different balances go into it. Default order, 401k barely touched for a decade. The balance reaches about $1,235,000. First required distribution, just over $50,000. Forced. Engineered order. After 5 years of withdrawals and conversions, about $709,000. First required distribution, roughly $28,800. Same assumptions behind both. 5% growth, withdrawals across the year, conversion tax paid from outside cash. More than $21,000 a year of income they are compelled to report. In the default order that the other version simply does not have. Every year, rising as the divisor shrinks, and those 250,000 converted dollars are out of the machinery. The conversion itself was income in the year they did it, at 12%, on purpose. Under current federal rules, qualified Roth withdrawals do not appear in a required distribution, do not enter the Social Security taxation test, and do not count toward a Medicare surcharge. In the default order, that same $250,000 comes out later, on top of a pension and 2 Social Security checks, at 22%. $30,000 of federal tax versus roughly $55,000 on this household's assumptions. One question for the comments, because it decides which order is right for you. Does your pension have a cost of living adjustment, yes or no? Many private pensions do not. Type yes or no. I read those because they tell me which pension situations to cover next. Part 4. The one decision you cannot take back. Everything so far can be adjusted. This next one cannot. When you retire with a company pension, the plan hands you an election worksheet. A single life amount that pays until you die and then stops. And joint and survivor options that pay less while you are both alive and keep paying your spouse afterward. Federal law makes a private sector pension pay a married participant as a joint and survivor annuity by default, with the survivor's portion between 50 and 100% of what was paid during your life. To take single life instead, your spouse has to consent in writing, witnessed by a plan representative or a notary. Government and church plans sit outside that rule. If yours is a state, county, teachers, or military system, go by your system's handbook, which tells you something. Congress required a signature and a witness because it knew what people choose looking at that worksheet in their last week of work. The single life number is the biggest one on the page. Say your worksheet shows $3,000 a month single life and $2,550 with a full survivor benefit. Your plan's reduction factor decides this, so use your numbers, not mine. That is $450 a month, $5,400 a year, that you are choosing to spend on her. Here is what it buys. If he dies at 78 and she lives to 92, that survivor option keeps paying her $30,600 a year for 14 years. Single life pays her nothing, and once payments begin, the form of benefit is generally locked. Some plans have a pop-up provision that restores the higher amount if the spouse dies first. Most do not. Ask. You will also hear the alternative. Take the single life check and buy life insurance with the difference. It can work. It also depends on being insurable at 65, on a premium that never rises past what you saved, and on that policy still being in force 30 years later. A pension survivor benefit carries none of those conditions. Get the illustration in writing and have somebody who is not selling it read the page where the premiums go up. Now stack that against what else arrives at the first death, all at once. Whichever Social Security check was bigger continues, the smaller one stops, and her return goes from joint to single. That $47,500 deduction becomes $24,150. The 12% bracket that ran to $100,800 now ends at $50,400. Half the shelter, most of the income. So look at what the two orders hand her. Default order, a check reduced for life to $2,600 a month and a $50,000 required distribution against single filer brackets. Engineered order, $3,720 a month, a required distribution of $28,800, and a $250,000 Roth account that produces no taxable income at all. On the Social Security check alone, over 14 years, that gap is more than $180,000. Here is the whole video in one rule. A pension is not extra income. It is the first tenant in a room that only holds so much, and it never moves out. So fill that room in the order you choose, not the order the paperwork chose. The account you control first, the benefit that grows 8% a year last, and the pension election decided with a calculator instead of a pen. 2 documents this week. Your pension election worksheet, with every survivor option side by side, and your Social Security statement, with the number at 62, at your full retirement age, and at 70. Put them next to each other before anybody signs anything. This is education. This is not financial advice and not legal advice either. Please walk your own household's real numbers through a qualified fiduciary before you sign anything, because your plan's factors and your state's rules are not the ones in this video. If this changed the order you were planning to use, tap like, so it reaches somebody else who is a month away from filling out that packet. Subscribe for the next pension, Social Security, and RMD breakdown, and type the word order in the comments if you want a full walkthrough of the survivor election worksheet. See you next time.